Hello and welcome to episode 294 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. How are you doing?
I'm good. I'm probably like lots of people listening to the podcast. I'm juggling the working from home and kids half term sort of headache. So yeah, I mean, I'm coping. I'm able to do it, but you know what it's like. It's never the easiest, especially as their half term holidays seem to be getting longer each year. I don't know about your kids, but like 2 weeks seems to be the norm now.
Yes, it's a strange time, and like you say, talking of working from home, actually, that brings me on to one point I wanted to bring up with you. I think we mentioned it in episode 289. We talked about working from home and claiming back money for working from home for the expenses that you incur, like the heating and everything else. Well, I've got some good news for you. On the back of that podcast, did it. I filled in the P87 form, and I heard via HMRC and my pay packet this month, I've got some money back. So that was a win.
Oh, that's good. I mean, it's not good news for me; it's good news for you. But that is brilliant. But that was, if you haven't heard the podcast, go back to 289 because it's actually very straightforward. Clearly, to be able to claim back this tax relief that you can get for your energy bills if you had to work at home, and you don't have to provide any evidence for the working at home that you've done. So Andy just proved it. The details are in that podcast, but that's fantastic because you are proof that it's easy to do and you can claim the money. And actually it's happened. Well, that must have happened pretty quickly then, because that must have only been within the last sort of month or 6 weeks that we did that show. So that shows you get the money back already, the tax relief. I take it they've changed your tax code. Is that what they've done?
Yeah, that's exactly what they've done. They've made an alteration to the tax code. I got an email alert to say that they'd done it. So I kind of knew that it was happening. And when my payslip came through, I checked it. And lo and behold, you look at the net amount in the payslip there, and there's extra money this month compared to last month and the months before. So you can see that it's all gone through. So really straightforward, well worth doing, and that money can help towards the extra money I've had to pay out in half term to keep the children quiet on all the movies. So all good stuff.
Hashtag winning.
Yeah. What are we going to talk about in this week's pod?
Right. 3 pieces we're doing this week, obviously, as is the norm. I want to talk about negative interest rates and investment portfolios. I've had the question sent in about what could be the impact of negative interest rates in the UK. So if the Bank of England sets interest rates below zero, what can investors do, or should they be doing anything? The second piece I want to talk about is a tax piece, and it's relating to people who are self-employed. So take a freelancer, for example. There are people now, and I'll explain more in the piece, who are facing tax bills that exceed their earnings, and that tax is not tax they should have put aside for past earnings. It's to do with their payments on account. I'll explain more in the piece, as I've just said. But if you're self-employed, you're supposed to pay payments on account every 6 months, which effectively pays tax on earnings you've not earned yet, or you're in the process of earning in that current tax year. And you can get to a situation where there are lots of people who are facing huge tax bills, yet they've not had the earnings to justify them. And they're facing, well, in some cases, they're worried about bankruptcy, losing their home. So I'm going to cover that and tell people what they need to do.
And the last piece I'll be covering, and we'll be looking at 5 ways in which you can move house quickly. So we covered the property in a pandemic is now the time to move in last week's podcast. And those who listened to it would have heard that Verona and Ben were talking about this ticking clock where people are trying to rush through their property purchases and sales before the end of the stamp duty holiday deadline at the end of March next year. So we can provide 5 quick tips if you're in that position, or if you're thinking of doing it, how you can get that moving quickly. And that's at the end of the pod. So what are we going to start with?
Let's start with the negative interest rate piece. So where we are at the moment, the Bank of England base rate is down at 0.1%. We've seen it cut obviously this year, and we're in a situation where we are looking at lower rates for longer. And in recent weeks, the Bank of England has written to banks to ask them if they are ready or potentially ready for a negative interest rate environment. So that would be the base rate going below zero. So that has obviously got a few people ruffled a few feathers and got a few people worried, because that is obviously something we've never seen. We are currently at an historic low in interest rates, but negative interest rates we've never seen in the UK. So what is the impact going to be for investors? I mean, we've touched upon it on the website. You haven't seen what the impact could be for mortgage borrowers, so if you've got a mortgage, or for current accounts. And actually, go back to podcast 96. So that's a long way back. This is, I think it's in August 2016 is the date. So it just shows you how these podcasts are evergreen. I went back, and in that show, I talked about the potential for negative interest rates, funnily enough, because it shows you how this story comes back every now and then. Back then, interest rates were at 0.5%, and the narrative was that the Bank of England was going to slash rates, and then people were worried about potentially negative interest rates. They obviously didn't arrive. But in that piece, I talk about the impact on banking and what could happen with negative interest rates. Would they be likely? I actually talk about how it's impacting fees that banks are charging potentially. So go back and listen to that rather than me cover it off. And also what's quite interesting is my predictions that I made then of what would actually happen. Most of them did come true, which is quite nice to see. So just in short, you're not likely to see negative interest rates on a mortgage, just to cover that one off. You're not going to be paid to live in your house, although we have seen some odd things in Europe along those lines. Because don't forget, we've seen negative interest rates from the European Central Bank and in other parts of the world already. So what does it mean for investors? Now, if you're an investor, a negative interest rate potentially could be good news for bonds. Now, if you think about bonds, what they are, particularly in this piece, I'm talking about UK gilts. So a UK gilt is effectively a loan to the UK government. So there is an amount of money, the principal, that is lent to the government, that is paid back at an agreed term, an agreed time in the future. Let's say it's 10 years, and there are interest payments throughout that period. Now, in a negative interest rate world, then that will likely see pressure put on the yields of gilts. So the yield on the gilt will likely continue to fall. So if the yield falls, that means the price of bonds go up. So just think of it, generally speaking, low interest rates are positive for fixed income. So that is typically things like gilt. And that's because if you think about it, if the interest rate in the wider economy is falling or very low, then those fixed interest payments, the coupons on a bond, and in this case I'm talking about UK gilt, look more and more attractive because they're fixed. They're set in stone at the opening of the contract. They look way more attractive when interest rates are falling, so people want to buy those gilts because obviously they can be traded in the investment market. So what that does, it pushes the price of those up. So lower interest rates and negative interest rates could be good for UK gilts and bonds. And if you think about it more widely, why would that also be good for bonds? Because it's a reflection of the economic environment that you're in. It's a reflection of the fact that the economy is probably struggling, that inflation isn't about to appear anytime soon, and you may be in a disinflationary environment, which means that prices are falling. So therefore, something like bonds become particularly attractive because if inflation rises, that means interest rates normally are ramped up to cope with that. That makes bonds unattractive, those fixed coupons less attractive, so people sell them. So in theory, if we start to see negative interest rates in the UK, so the bank base rate, the Bank of England base rate is set to negative and keeps going that way, it should be positive for UK gilts. Of course, if you look at the UK gilts, we've already seen negative yields on those this year. So on the short term, so we're looking around about the 3-year mark. So there already were negative yields appearing on UK gilts. And so we might see that increasingly happen. And it may seem odd that the yield is negative, but what it really means is that people are willing to pay more for the gilt than the principal amount of the loan that they would receive at the end and the income payment. So that actually means the yield, that return when you work it out, is actually negative. But that shows you the environment that we would be in, that people would want to do that. Now, if you jump across the stock market, then negative interest rates should be positive for stocks as well. And that is because a stock price, so a share price, is really a discount mechanism. So it's a discounted value of future potential earnings and potential dividend payments effectively. So if you think about that, that means that if you have a low interest rate, then the present value of all those future earnings discounted back is actually higher, and therefore means that the price of a share would reflect that. So it should be pretty buoyant. And if you think about it, from the last decade or more since the financial crisis, the stimulus that we've had from low interest rates has been net positive for stock markets. So what we're seeing is that you're going to probably have a boost. If rates keep falling, it will probably be good for the stock markets in a broader sense. Now, there are some nuances. Growth stocks tend to be more attractive in a low interest rate environment, and a growth stock may be something like technology companies. Now, if you think about it, a lot of technology companies are growth stocks because the money that they generate or the future earnings that they're going to produce are a long way off. So if you think about a company that's starting to grow and become bigger, the point at which they become profitable, because a lot of technology stocks or companies aren't particularly profitable in the early years, then later down the line, that's when they get into scale, and then lots of people use that particular technology or platform, then they make all their money. So those future earnings are a long way off. Now, if interest rates are low, when you discount that back to today's values and price that in today's terms, if interest rates are low, trust me, it's the way the mathematics works, then that increases that present value of those future earnings off in the distance. So that makes growth stocks more attractive. So if you think in the UK, or even if you see negative rates in other parts of the world like America, that will probably be good news for things like technology focused companies. On the flip side, cyclical stocks like finance, so banks, low interest rates are a headwind for them, because if rates are low, it makes it more difficult for banks to make profits. So their profit margins are hit. So what you'll see is things like bank stocks probably underperform things like technology stocks. So you'll probably get a bit of a disparity between growth stocks and more cyclical sectors. So expect that to happen. Also, in an environment where interest rates are low, and if they're negative, it encourages institutions to look elsewhere for a return on their money. So if you're a company with a huge cash pile, it will encourage companies to do more buybacks. So share buybacks, and all these things tend to be positive for share prices in the long run and shareholders. So we could see more of that activity. So this isn't a one-in-one relationship. It's not like a direct correlation, but if rates become increasingly negative, then it could be positive for bonds. That seems to make more sense, but it can also be positive for stock markets. And we've seen it happen in Europe over a period of time, but there are lots of other factors that influence how an asset performs and its price. So it should generally be a positive for those two asset classes. Of course, one thing that will happen if you're an investor is that the value of sterling will likely fall, because if you think about it like a bank account, it's not a bank account, but just give people an analogy, that if interest rates on a bank account tumble, you won't want it. You'll shop around, you'll go elsewhere. Currencies kind of work in the same way. So if interest rates are low, then speculation on the pound versus other currencies will fall. So what will happen is people will start to sell the pound. The pound will become weaker. So what you'll start to see is that impact your investments potentially. A weak pound is pretty good for the FTSE 100. It does mean that it could give a boost to your overseas holdings. So there is a line of thought that if we start entering this long extended period of negative interest rates, then if the pound starts to weaken because of that, you'd be better off holding overseas assets, and particularly overseas equities. So that is something to consider. The other thing is, as an asset, gold starts to look a bit more attractive. Now, gold is one of those assets. It doesn't yield anything and it doesn't do anything. It doesn't provide you with an income. But of course, if you're in a world where cash is negative yielding and you've got bonds that will ultimately be negative yielding in terms of UK gilts, something that doesn't yield anything starts to look a bit more attractive. So gold, in a world where we see currencies devaluing, becomes more attractive. And of course, as I mentioned, the pound will likely devalue in a world where we have negative interest rates. So gold starts to become much more attractive. So from an investor's perspective, are there things they could do? Yeah, as I mentioned there are things, assets they could start to look at. But don't forget, a lot of this stuff will be starting to be priced into markets anyway. And there are lots of other factors that start to influence the returns that UK investors get. And just to give you an example, this week, we saw the pound rocket. So the pound was up above, I think, $1.31. And that strength came in a week where at one point Brexit talks between the European Union and the UK faltered. And obviously we've got a second wave of the coronavirus, and it doesn't seem logical that the pound should strengthen in that environment. And what happened, we saw some optimism around those talks. They're happening again, and they're hoping to conclude them by mid-November now rather than mid-October. But on the flip side, the dollar weakened. And of course, currencies move in tandem. They're not in isolation. So with the dollar weakening dramatically this week, that meant that the pound strengthened because it's like a seesaw. One goes down, the other will go up. And of course, there was a little bit of positive news for the pound as well in there. So that helped push it up because of those Brexit talks that I mentioned. There was some optimism. And because of that, you will have seen your overseas holdings in your portfolio this week take a bit of a hammering, even though the equity markets themselves didn't fall a lot. And that just shows you that trying to invest for a world where there are negative interest rates, particularly in relation to the currency, can be very difficult. There's lots of moving parts. And don't forget, we've been in a world where real interest rates, so that's the return taking into account inflation, has been negative. So if you think about, let's take a bank account, you're getting, let's say, 0.5% at best on some current account, easy access. Well, inflation has been in recent times much higher than that. And so your return has been negative. So your money is actually losing value. So we're already in a negative interest rate world in real terms anyway. So it's a very interesting question, and it'd be interesting to see what happens in the sort of coming months and years, and if we even do get negative interest rates. At the moment, they're thinking it could be likely in 2021. But as I pointed out at the beginning of the pod, I did a piece 4 years ago that first mentioned the impact of interest rates could have on personal banking and personal finance. And we're still here 4 years later and we've not yet had it.
Okay, so moving on to the next piece in the podcast, we're going to be talking about tax. And there was a weird kind of quirk that came up in a story that was in the national press. And Damien, you read this story and decided to have a little deeper dive into it and thought it would be a good piece for the pod.
Yeah, so the piece appeared in This Is Money, which is the money section for the Daily Mail. And it was an article called Fleecing the Freelancers. And now the article was centered around this phenomenon we've got now where there are freelancers or self-employed people, sole traders, who are facing large tax bills at the end of January, so the 31st of January 2021, that they're going to struggle to pay. And these tax bills will end up being larger than their earnings post-COVID. Because you've got to think, there are a lot of people out there who are self-employed, they may be freelancers, and their work has dried up. And this particular article focused on a chap who was a photographer, I think he was, and his earnings had collapsed because there were no weddings really going on, and he'd earned only about £3,000 since lockdown, but he was facing a tax bill at the end of January that was in 5 figures because the previous year he'd had a very successful year and had been up until that point running a successful business, earning good money. Now, before people think it's just because the guy hadn't saved up his tax, that is one issue, that there are a lot of people who don't save their tax as they earn it if they're self-employed, which you should do because you're going to have to do your self-assessment. So there's one takeaway I want people who are listening to this podcast anyway, is if you're self-employed, don't live hand to mouth where you're just paying your tax bill each year out of the income that you get. And there are lots of people who do. I know there'll be people listening thinking, do people really do that? I know people who do that. So don't do that. Save up the money as you earn it and put it aside into a tax account. But of course, if you are self-employed, then you also have to pay something called payments on account. So if you take, for example, last tax year, so the tax year that ended in April 2020, when you do your tax return for that particular tax year, you have to pay the tax that's owed at the end of January 2021. But you also have to pay something called payments on account. There's 2 of them. There's one in July this year that would have happened, and one in January at the same time as your taxes due on the full tax year for 2019-2020. You have to pay tax effectively in advance for the tax year we're in now, the one that's going to end in April 2021. If you're not self-employed and don't do your own tax, you might not realise that. So what the taxman does is he wants to make sure he's getting his money almost as you're earning it. So what they do is they base these payments on account. So let's say for this year, although the tax year's not ended, they base those 2 payments on account on your previous year's earnings. So the tax you would have paid the previous year is used to reflect what the payments on account for the next upcoming year will be. So you can get into a situation then, which is what happened to this chap, and it's happened to millions of people.
I was going to say, there must be so many people in this situation.
And there's going to be millions of people in a situation where suddenly the payments on account that they had in July, and don't forget that the government allowed us to postpone any tax that was due in July this year. So those payments on account, people who were self-employed were able to postpone them to be collected at the end of January. So it was almost like now a double whammy coming on. You've got your tax you're going to have to pay for the tax year that ended in April. So when you've done your tax return, that's going to have to be due. That's the sort of the balance, because don't forget you've got the payments on account that have been going for that year previously. So you're paying, just finalising your tax bill for that year. And then obviously the payments on account are going to be taken now for this current tax year. So what it means in total is that you could be looking at a very significant tax bill, but have got no earnings. And because a large part of that tax bill will be for the current tax year that was projected to be as good as, for this guy, I think he was earning £50,000 a year, presuming that he was earning £50,000 a year still, he's got a tax bill for that. And of course, that is a huge problem. And the paper was saying about how there were people facing almost bankruptcy, going to lose their homes, the stress and everything like that around it. But what I wanted to do was obviously highlight this issue for people who hadn't maybe thought about this as coming up, but then give a bit of practicality around it, because there are things you can do. The story, in my own opinion, was very sensationalist. It was all very dramatic, and obviously it didn't really, in my view, give any takeaway, any action points. When we do anything, it's all about the action points. So if you're in that situation, then this piece is for you. Now, Royal London did some analysis, and they said that for somebody who was earning £50,000 pre-COVID, so the pre-outbreak, and let's say their earnings have dropped this year to £15,000, so it's a significant drop, they are looking at a tax bill of the region of about £16,682 coming up. So if you've earned £15,000 this year because your earnings have dropped, that's a good example showing how you can actually have a tax bill that's bigger than the money you've actually brought in the door. Now, interestingly, I got in touch with our accountant that we use to actually get an accountant's view on what these people should be doing. Now, one of the things that you can do is you can change your payments on account. You are able to do that. You've always been able to do that. That is nothing to do with COVID. You've been able to go and request to have your payments on account changed. So you could, by post or online, or via an SA303 form. So if you Google that, you'll find it. You can request for your payments on account to be changed. And of course, the thing is, in a normal world, you wouldn't want your payments on account to be lower than they should be, because what happens when it gets to the point where you've got your balance payment, when you actually get to the point where you've done a tax return and the January following the end of that tax year, you pay the balancing payment, then if you'd had payments on an account that were lowered and it basically meant that you were underpaying, then you could be liable for interest and charges. So that's the way the system works. That's why you want your payments account to be effectively, you get to that point in January in a nice way, you're all square. You haven't got much of a balancing payment to make. So if you're in the situation that this chap was, don't sit on it. Take action. Speak to an accountant if you're not confident in doing it yourself, and you could potentially reduce your payments on account. And that will be for the payment on account that's coming in January and July next year. The other thing is that I mentioned that the one in July, the payment on account was able to be deferred to January, which is why this guy's got an even bigger bill. But if your bill is got to the point where it's less than £30,000 and you're going to struggle to pay it, the government has announced a time to pay initiative, which will allow people to be able to pay over a period of time. So monthly for a year. So that is almost deferring the full payment again until the January 2022, but it's giving people the ability to try and pay this money over time so they're not struggling because of the unfortunate circumstances and the situation caused by COVID.
So there's an option there to break down that bigger chunk and pay it in more monthly manageable chunks. And so it's not all doom and gloom. There is a solution there for some people.
Yeah, and the thing is, the reason you want to engage with, we'll put links to all of this stuff in the show notes, so that the details of the ability to defer, the forms we've talked about, and the article in question, actually, because people may find it useful. But the point is, you need to engage with it, because in a normal scenario, then if you are late in paying your tax bill, then you can incur penalties and charges and interest. So you want to make sure you engage with it. Don't bury your head in the sand and hope things get better, because as we're already learning with this second wave of the coronavirus, we don't know when things are going to return to normal. So there are a lot of people out there who don't know when their earnings are going to return to normal. And of course, for a lot of people who are self-employed, they've had limited help from the government. So in terms of the self-employment income support scheme, they may have had some help, but there are people who are directors of companies who have not even be able to get help via that. So for those people, this feels like a double whammy. And it's not just because they're not paying tax. People who write comments on newspaper stories don't half the time read or understand the predicament that people are in and actually the nuances. There are people who are being asked to pay tax in advance for earnings they've not now earned. And so there is something you can do about it. Don't just bury your head in the sand and think it will go away.
And of course, those people will also say, yeah, but in 12 months' time, you'll be able to post your earnings and you'll have earned less, and so you'll pay less tax next time around. Well, it's getting to that next time, isn't it? It's being able to deal with it now and to get to that point.
Yeah, and because some people are therefore, well, they could potentially, businesses go under, they could go bankrupt, all these things. They've got to try and stave that off so they have an ability to recover in the future. So the takeaway, like I said earlier, do put your tax aside as you're earning it. And if you are unsure how much you should be putting aside, then we'll link through to some calculators for you. Because on the official .gov website, so .gov.uk/estimate-income tax is a good way of estimating. It's a calculator that allows you to estimate your potential tax. So when you have money coming in, you should be putting aside a chunk into an account, a savings account that you won't touch. And in doing so, it means you can actually shop around and get some better interest rates. Don't tie your tax up for years because you're going to have to access it. So just to try and get a better rate, do make sure you can access it when you need to, so you can pay your tax bill. So that's the first thing. I mean, there are others. If you're a director of a business and you're being paid by salary and dividends, it's again a little bit trickier, but there are calculators out there. We'll link to one, but itcontracting.com is a website that has a number of calculators. It's all about IT contractors basically, but they put calculators on there to help those sorts of people who have these tax situations to try and work out how much of their dividends and their earnings they need to be putting aside, to tell them how much tax they will be paying on their earnings and that will be liable or due on their dividends. They can put that aside, and it's very useful. Be on top of it so you get less shocks when it comes to having to pay it.
Okay, so that moves us on to the last piece of the podcast, and it's just a short piece, and it really follows on from the property podcast that we did last week. And if you'd have listened to that podcast, you'd have heard Verona and Ben talking about the fact that time is running out for those people who are trying to take advantage of the bonuses that are available through the stamp duty holiday. Obviously, people can save potentially up to £15,000 if they get their property sale or purchase through before the 31st of March. So it begs the question, how do you speed up that process? And so Laura, our consumer credit editor, has written a brilliant piece on 5 ways to move house quickly. So I just wanted to touch quickly on the 5 points for those people who are maybe thinking, do you know what, I wasn't sure whether I wanted to move, but have we got time? These are 5 tips that could help you if you're thinking of doing it. So tip number 1 is choosing the right estate agent. Now, we've actually got a link that you can link through to on the article. We'll put it on the notes on a company called Get Agent, and they're brilliant. What you can do by using those is you can actually filter by postcode estate agents in your area. The great thing about them is you can actually filter them by how long it takes to get a property through to sale or purchase.
Do they also, from memory, I think, show you the agents that get the best or the highest, what's the word I'm thinking, the greatest percentage of asking price?
Exactly right. Yeah. So you can filter it by 2 things, which is speed, but also percentage of asking price that the agent achieves. So, I mean, really, from looking at the research, you want to find a good balance. You want to find a balance of speed and value, but you can do that on Get Agent. The link's on the website. It's a really good tip. Tip number 2 is weed out the time wasters. So if you're looking to sell your property in order to buy, what you want to do is you really want to go with people who are what they call proceedable. Now, that means people who are cash buyers. You want to keep the chain as short as possible. First-time buyers, cash buyers.
You don't want carpet treaders around your house.
No.
I remember when I bought my house, and it's a long time ago now, when I talked to the guy, I knew it was at a point when the market was really a seller's market at that point. And I remember speaking to the guy and pitching myself to him while I viewed the house, I think for the second time, because I knew there were about 3 or 4 couples trying to buy the house. And it was clearly one of the nicer houses in terms of, at that point, people were selling houses that just had damp for ridiculous prices. And this was one that wasn't anything wrong with it. And my basis was about the fact that I think we'd already had a mortgage agreed in principle, but also that I worked in finance, blah, 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 all this stuff that basically meant that
we're selling yourself to him as much as the house being sold.
And it worked because he thought, well, do you know what? I've got the least problems with these people because they're going to be able to go through. And it worked. And I mean, it might feel a bit embarrassing doing that, but at the end of the day, if you want a house, you want a house, don't you? you?
Exactly right. So if you're in that position, if your estate agent is coming around saying we've got 3 or 4 people, find out who are the time wasters and who are the ones who are actually going to proceed through to a sale. And you actually just mentioned there, Damien, decision in principle. That's our tip number 3. Get your decision in principle early. Make sure that the estate agents are aware of the fact, you're a serious buyer. And so hopefully that will put you at the top of the queue in terms of buying the property. Number 4, a really simple tip. So many people don't do this. You get your ducks in a row. Don't expect the conveyancer, the estate agent to do all the work for you. Get your ID sorted. Make sure that you've got your documents certified. Double check the lender and what they're going to require. Get online. Basically, do the work prior to actually applying. It can save you days or even weeks. You don't want to wait for that letter to come through to say, oh, can you give us this? Already have it and tell them, and even start sending that stuff through before it becomes an issue.
Yeah. I remember on the live event, Verona and Ben said about how to speed up, just let it go, effectively. It was like the Frozen version of
just let them do their thing.
Let it go. But I'm of the opinion personally, I wouldn't, because it seems to me in the world of conveyancing and sometimes in the world of mortgages, he who shouts loudest gets basically heard. And if you get left to the bottom of the pile, it was like that when I moved house again, 13, 14 years ago. But from all of you guys who've bought and sold properties in the last year, it still seems to be the same thing. And another thing that when I was talking to Ben off the live event beforehand and chatting, one of the things he highlighted is that when you go to a mortgage broker right now, because of the surge post COVID and because of the stamp duty holiday, there's so many people trying to get a mortgage. What mortgage brokers are having to do is obviously put their cases through to the lender. They have to basically key them in on the system to get the application in the system. But lenders are limiting the number of cases in the UK. That's not per broker, per mortgage advisor. That's in the UK. So there are people out there, and if you're a mortgage broker, you'll be nodding if you're a decent one, who are sitting in their bed at 5 a.m, firing their laptop up, trying to push through the applications from their clients the day before to get them in. And then they're all sort of messaging each other going, did you get your applications through? So you want to make sure that the mortgage broker is putting it through and they are prioritising you, because if they're the kind of person who's rocking up at their desk midday and then might try and put these applications through, at this current moment in time, it's going to delay things. You're not even going to be in the pipeline. So that's a tip. So do basically make sure that they're doing their job. So I know people out there are going to go, Damien, you just caused me a headache. But at the end of the day, that's the world we live in.
So we've looked at estate agents, mortgage brokers. The final tip is on the conveyancing side. Just be smart about who you choose. Ask the right questions. When you make that decision on who your conveyancer is going to be, ask them how many cases they're working on. How busy are they? They might not give you a straight answer, but at least ask the question. Consider an online option. There are lots of online conveyancers that specialize in being able to get cases through quickly. Don't assume that they're going to be the quickest, because sometimes going with someone local who's not particularly busy, albeit it's unlikely at this time, may be the better option for you, because you can pop down and give them all the documents and actually almost like oversee the process. So just be proactive, think about who your conveyancer is going to be, ask the questions, and hopefully those are a few good tips.
But as Andy mentioned there, I remember bringing out Andy's personal experience. He did use one that had a very good online portal. And so he could see that, where conveyancers don't have time to call you, they could see things were being actioned and things were moving, because that's the worst part. Communication in a lot of house moving is non-existent. And so hounding agents and all that, that's why you end up doing it. And I do understand where Ben and Verona are coming from. Just let them do their job. The problem is if you have no visibility that they're doing their job, that's where the frustration comes. So the only way you can end up finding that out is by calling them, or in the case of Andy, who ended up having a conveyancer that had a very good online portal that came actually via an online broker who used them. It was all part of that service. Then that could save you some restless nights.
A final bonus tip at the end is to check out the article that Laura has written. Is 5 ways to move house quickly. And the reason I say to head to that article is we've actually posted an image in there, an infographic, which displays the lenders that are quickest in terms of processing your application. So I can't do it all in the podcast.
Who's quickest?
So the quickest is actually Barclays, closely followed by Halifax. But actually, to see the full list, you need to go.
Yeah, but now we've said it, people will try and use them, and it will just all go to completely wrong, and it will end up being the slowest. So do go and have a look at that article. There's a lot of useful information in it. And one final thing, this won't make it happen quickly, but do go and listen to Verona's views on selling, renting, and then buying. So basically making yourself a cash buyer at some point in the future, which kind of goes back to the earlier tips about putting yourself in a better position. But it may be you go and live somewhere and you try that area, if it's a new area you've never lived in, and see what you like about it, where's the best place to live before you actually buy somewhere. But you can find that obviously on our YouTube channel.
So that's it. We're done for this week. If you want to get in touch with Damien, you can do so. It's damien@moneytothemasses.com. If you want to contact me, you can. It's andy@moneytothemasses.com. Twitter, it's @moneytothemasses with number 2. Don't forget to join our Facebook group, facebook.com/groups/money to the masses. And we've got lots and lots and lots of stuff happening on YouTube at the moment. There's 2 videos going live every day for the next few days.
And if you're still obviously listening, which I hope you all are.
No, the music started. They've gone.
No, next week we're doing something different with the podcast, which I'm really excited about. And I think that I really want to hear people's feedback on. So that is something to look forward to.
Great stuff. Until next time.
Until next time.